Hello viewers, in this video I'll be going over the S&P 500 ETF ticker symbol SPY. In this video we'll be going over the day-by-day probability and the forecast model for the S&P 500. So the forecast model is now available in the link below, so do check it out. For the S&P 500 you'll see all the models that we do not go over with in the video. So back to the technical analysis. We are currently up 7 basis points, and on the 1 hour chart we were touching overbought RSI. However, we see a divergence created over this morning, and for the 4 hour chart we start to see a divergence here on the 4 hour MACD as well, and we are dipping out of overbought RSI. However, we are still remaining on support, this 9 moving average on the 4 hour chart. If we expand out to the daily chart, we see we are currently still overbought on the daily RSI, and we currently made all-time highs today. So as for resistance, since we made all-time high today, the resistance will be $323.80. And as for support, I do see possible support being the 18-day moving average. Reason why, we see a slight price concentration around that range, and that is around a price of $317.25. And if we were to move down lower, that price movement is roughly around, it is around 1.7% to the downside. And back to the forecast model. So let's head to the day-by-day probability model. On here, we'll see where the S&P 500 will most likely head to next coming days. So what we have is 1 day out all the way to 7 days out, so on to next Friday. At the moment we see a higher probability and 1 standard deviation down and 1 standard deviation up. However, there's more likelihood we may hit 2 standard deviation up as the day progresses, and we start to see it's favoring to the upside as well, as it's much higher on the extreme case being 1 to 2% up. And however, we still see a slight over increase to the downside, down between 1.3% to 0% down. So let's head to the forecast model for the S&P 500. So we have 1 day out, 2 days out, 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these models we should focus on? Ideally, the model that is the best match to the current trend. Right here we have the current trend, and below is the trend that I believe is the best match. This trend dates back to December 28th to March 26, 2012. So let me point out why these two charts are similar. It's quite basic. What we see is we average above the middle Bollinger Band for several weeks, and then we take a slight dip below the middle Bollinger Band at this instance. Next we see another average above the middle Bollinger Band for several weeks as well, right towards the end. So we see those 3 points, and then on the trend in question we start to see a similar pattern as well, average above the middle Bollinger Band for several weeks, and then we see one instance where we dip slightly below the middle Bollinger Band. Afterwards we see it average above the middle Bollinger Band again once more and touching the upper Bollinger Band. So what we have is 1, 2, 3 points. We also have 1, 2, 3 points. So there's reason to believe that the trends and patterns are the same. The outcome and forecast should be fairly the same. So the model that we just examined was December 28th, 2011 to March 26, 2012. Back then the S&P 500 would most likely be down around 26 basis points. So that also coincides with the favor of right here, the day-by-day probability. On the 7th day, we have a 44% chance. That's among the highest, what we see on the 7th day. So we most likely head down lower in next coming days or in 1 week for the S&P 500. Again, this forecast model is now available in the link below, so do check it out. If you enjoy this content, feel free to like, comment, subscribe, and thank you for watching.